Have you ever wondered how businesses manage their finances? It might seem like a daunting task, but with the right techniques, it becomes an organized process. One such technique is double-entry bookkeeping. In this system, every transaction is recorded twice, as a debit in one account and a corresponding credit in another. For example, if a company purchases inventory for $500 in cash, it would record this by debiting the inventory account, increasing it by $500, and crediting the cash account, decreasing it by the same amount. Now imagine a consultant who provides services in December, but only receives payment in January. Under cash basis accounting, this revenue is recorded in January when the cash is received. This method records transactions when cash changes hands, without considering accounts receivable or accounts payable. However, under accrual basis accounting, the revenue is recorded in December, when the services are provided, not when the payment is received. This method matches revenues with the expenses incurred to generate those revenues, recording transactions as they occur. Another essential technique is bank reconciliation. This involves comparing the company's records of cash transactions to the bank's records to ensure they match. For instance, if a company's bank statement shows a $50 bank fee that wasn't recorded in the company's records, the company would adjust its records to reflect this fee. Now let's talk about journal entries. These are the initial recordings of financial transactions. They typically include the date, accounts affected, and amounts debited or credited. For example, if a company pays $1,000 for insurance coverage for the next 6 months, the journal entry would debit the prepaid insurance account for $1,000 and credit the cash account for the same amount. Finally, we have the general ledger. This is the primary record of all a business's financial transactions. It includes separate accounts for each type of asset, liability, equity, revenue, and expense. So you would find separate accounts for cash, accounts receivable, accounts payable, inventory, revenue, rent expense, and other financial categories in a general ledger. These techniques are fundamental in helping businesses maintain accurate financial records, track performance, and comply with reporting requirements. The choice of technique depends on factors such as the size of the business, regulatory requirements, and management preferences. Let's go through a few scenarios to illustrate these techniques. First, suppose a company purchases inventory items for $1,000 in cash. The journal entry would debit the inventory account by $1,000, increasing assets, and credit the cash account by the same amount, decreasing assets. Next, imagine a company sells goods to a customer on credit for $800. The journal entry would debit accounts receivable by $800, increasing assets, and credit sales revenue by the same amount, increasing equity. Finally, consider a company that pays rent expense of $500 for the month. The journal entry would debit rent expense by $500, increasing expenses, and credit cash by the same amount, decreasing assets. These are just a few examples of how bookkeeping techniques work. As you can see, they are crucial for keeping businesses financially organized and compliant.